87% of Americans are terrified of retirement, and it's not because they haven't saved enough. It's because they don't know how to turn a pile of money into a stream of income. We've been lied to. We've been told that a paid off house is a trophy, but it's not a paycheck. I want to go ahead and share an article with you guys that I've been looking at and reading. This article is, I don't know, I feel like it's pretty insightful to the way a lot of people feel. So I'm going to go ahead and share my screen here in 1 second. I'm going to go through this article and go through a few other things today. And I just want you to kind of see this. So, um, love it when my screen freezes. Anyway, Prudential study reveals retirement planning gaps. And this is in this article, they found that 87%, excuse me, 89, um, feel that they won't, let's see, 89% of the mass affluent Americans believe that they'll be able to cover essential costs in retirement, but many have not taken the keys or taken the steps to ensure those savings will last. If we go down to just general rest of the Americans, 87%. Here we go. That finding dovetails with the recent 2025 U.S. retirement survey by Schroders, which found that 87% of Americans who've yet to retire expressed at least some concern about not knowing how to produce income in retirement. We have been lied to. We've been told that paying off a house is a good thing. Now, paying off a house is a good thing, but if you don't have the income that you need, then paying off a house can become an income. And I want to talk about that a little bit, but I want to make sure that it's understood. I'm not suggesting that everybody stop paying their houses off. I'm just suggesting that people take the time to understand more of what's going on in their own finances. It's definitely gotten more expensive lately to live and to do the things we have to do. Homes are really expensive and we're all kind of acclimating to that, but we just need to understand the value of having a house paid off versus the value of having the income. And so in this I'm going to go ahead and stop sharing actually so we can kind of just talk eye to eye again for you or with you. But 87% feel that way. That's a overwhelming majority. So that tells me it's on a lot of people's minds what future retirement is going to look like. Well, let me just give you a quick explanation of a paid off home and how it connects to reverse mortgages. Now, reverse mortgages are interesting. Reverse mortgages are I think a lot of people think they're satanic or something like that, based on some reactions that I get. It's super funny to me. A reverse mortgage, guys, is just a mortgage. It's in many ways extremely similar to any normal mortgage. It's structured a little bit differently, but there are different types of mortgages, and different mortgage types have different values to different people. Okay, so other than that, it's not an emotional thing. So if you're listening to this and you think reverse mortgages are evil, I would challenge you to open your thinking and just get some facts. The two biggest leading misconceptions about reverse mortgages, since I brought them up before I continue, is number one, that I'm going to lose my house. I'm going to give up my house to the bank. The bank takes ownership to the house. Some version of that concern. That's not true. When you take a reverse mortgage out, honestly, it sits exactly the same situation. It sits exactly, it compares exactly to a regular mortgage. You have a lien on the title, you're the owner. If you honor the agreements, the house is still yours, right? On a normal mortgage, you have to make monthly payments or they can foreclose. On a reverse mortgage, there's no payments due. So they're not going to foreclose for that. What they would foreclose on is if you moved out of it, it's no longer your primary residence for over 12 months. That's the predominant requirement of a reverse mortgage, is that it be your primary residence for over 12 months. If it is not, or for any 12-month period, if it is not, then they do have the right to foreclose, but they usually just contact you and have you sell the house if the case like that. So they're not willing to carry a mortgage for somebody that's not living there. They don't want to reverse mortgage investment properties and things like that, for example. So reverse mortgage, you maintain ownership of your property when you take out a reverse mortgage. Second one, I'm going to lose all the equity in my house. Now, there are different versions of reverse mortgages, and there have been for many decades. And so it is possible that there's other reverse mortgages out there that had a scenario like that. Let me explain how the FHA version works. That's the most common reverse mortgage that's used, but it's also the most conservative. So a reverse mortgage through the normal channel through HUD. HUD is the kind of parent organization of FHA. That one will give you a certain, if you have, let's say when you close on the reverse mortgage, you have $300,000 of equity. Let's say that you're going to end up with something like a $250,000 principal limit is what they call it. You may or may not actually owe that much when you close, but that'll be your principal limit. And let's say that leaves you $300,000 in equity in the house. If you calculate all the numbers as they're projecting them, and real life probably is actually going to work out a little bit better. But if it does go exactly according to plan, then 5 years from now, you'll still have 300,000 equity. 10 years from now, you'll still have 300,000 equity. 20 years, you'll still have $300,000 of equity. So all you're essentially doing is taking a chunk of your home equity and you're converting it to be useful to you. And then the rest, if you want to give it to your heirs or whatever, it's still going to be sitting there whenever that day comes. Okay. Um, Now, why am I bringing up a reverse mortgage with 87% of the people being concerned about retirement? Well, if you get to where your retirement age and you cannot pay off your house, you haven't yet got to that stage. I'm sure me being essentially 50 years old at this point, I'm at that stage where I can already kind of feel where I don't think life is worth just working, 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 working until the day I die. I would like to spend more time with the family, with the kids. I'd like to make more memories. And frankly, I'd like to do more valuable things with my life than just get a paycheck. And so I imagine more and more people reach that point and they don't want to just keep working forever. And when they're 60, 65, and they still don't have their house paid off, they may be 70, 75, 80 before they actually get it paid off. They may have a different opinion at that stage that, you know what, I don't really want to worry about paying it off anymore. So if that's you or somebody you know, this is why I bring it up. So if you have let's say you have a $2,000 a month payment on your mortgage, and let's say you've got about 50-50 equity and versus how much you owe. You need to have a little bit more equity than what you owe. But if that's the case and you're able to get a reverse mortgage, the reverse mortgage will wipe away the payment requirements for the rest of your life. At no stage in a future point will they come back and ask for monthly payments, even if you make it to 150. That's the parameters of the FHA reverse mortgage. Now, that has a huge impact all by itself. If you've been making $2,000 payments and you reach that age and you're just like, man, just turn it off. If you can stop paying those $2,000 payments, that's going to have a big impact on your ability to retire, right? Second, what if I have actually been able to pay my house off or almost completely pay it off? It's just not quite there. I can actually use that to create an income for you. And so, kind of like having an extra Social Security, you have your Social Security over here, and then you get your reverse mortgage permanent payment. Reverse mortgage payment could be $1,000, could be $2,000, could be a little bit more. It's usually not a whole lot more than that, but it depends on your house's value and how much equity you have, how old you are. In most cases in Utah, you have to be at least 62 years old in order to qualify for any of these. So that's kind of, I feel like should be shouted from the rooftops for this 87% of the people that are feeling like they can't, they're really nervous about retirement. Look, guys, if we think we have to pay our house off before we can ever retire and we're $300,000 away from that still, that yeah, that can definitely weigh on us. But we can also just do a reverse mortgage, turn those payments off, and it's essentially feels the same way. Now, no, it's not exactly the same. You haven't actually paid your house off. You're actually still paying interest and stuff on the mortgage. Yes, granted. But whose life is this anyway? And how much of it do you have left that you want to continue to work and pay? Or would that have an impact on your life? I'll never forget the day where I'm sitting there in my office and this wonderful, we will call her a grandmother, a wonderful grandmother. She wasn't really old by any means. She wasn't some little old grandma. She was honestly, I felt like she was kind of a peer to me, but she sat there in my office and we went over all the details of the reverse mortgage. And I showed her that not only can she get a reverse mortgage and get rid of, I think it was a $900 monthly payment that she had left, but that I could give her a $1,200 a month income for the rest of her life. So it was over a $2,000 impact on her financial budget. She was really tight financially. She still had some ability to work and stuff like that, but it's just, she was getting closer and closer to a fixed income, and she had kids, I believe it was in Wisconsin, and grandkids. And she had somebody else, another state that I don't remember, but they were both distance, and she next to never saw them as a result. And so I showed her how she could do this, and she started crying. And the reason she started crying is because now she had a pathway that would enable her to be able to go see those grandkids however frequently she felt like she wanted to. And that, guys, honestly, at what point does our life become more valuable than the money that's tied to it? Money is just a means to an end. So, with that said, I want to kind of change gears now and talk about the second thing that well, let me just say this. Nobody ever steals $10,000 a month from you all at, or excuse me, $10,000 from you all at once. Nobody takes your money like that. They try to get away with little tiny chunks here and there typically, right? Why I frame it like that is because most people are being buried by their debt simply because they don't know which buttons they're allowed to push. Um, so why I'm kind of framing this way is back in 2008 when I was in this mortgage business, I remember starting to hear more and more news reports of people on the news being interviewed saying the mortgage company never told me about this and this and that. And they never told me about what my mortgage was going to do and da da da. Guys, that's a fat lie. I'm not going to say that what the way they told you was super easy to understand, but I'm going to tell you I've known enough people in my lifetime that that's a fat lie. That is a lazy response. I was giving those mortgages to people. I know what those mortgages said, and I took the time to tell every single one of my clients exactly what their loans said and exactly what they did. And I'm telling you, some of those loans were not great loans. And I'll get into that second. I'm going to talk about adjustable rate mortgages and are they scary? Are they dangerous? Talk about those here in a moment. But I want to first tell this story. So I had this client call me up just a few months ago. They had a HELOC, home equity line of credit, and it was drowning them. It was absolutely drowning them. The monthly payments, I want to say, were 1,700 a month. Let me see if I can find that. It was 1744 a month is what their HELOC payment was. But their interest rate was only 7.49%. That's a fairly decent interest rate. Why were they getting buried by it? And they called me up because they wanted to sell, and they called the agent up, their agent that they knew and trusted, because they wanted to sell, and the agent was somebody that was trustworthy and asked him more about why. And they said, well, before we sell your house, why don't we just have my lender look a little deeper into your finances and see if maybe there's a refinance so you can keep your house? And so then they get on the phone with me, and that's that conversation. So kudos to that agent that stood up for what's right and didn't just cash in a paycheck. I thought that was awesome. But then I guess I kind of followed suit. And so I started going through their finances with them, and I found that they have this HELOC. Interest rate was only 7.49%. Their monthly payments should have only been right around, I think it was 800. I didn't take my notes down on that one, but I want to say it was only 800 a month, but their payments were 1749 or 1744 a month. So I'm like, this doesn't make sense. What's going on? And I am going to say that they were banking with America First Credit Union. And I'm going to point that out because if you have a HELOC with America First, you're probably going to recognize this, but they're not the only ones. I know quite a few do this. And I'll be honest, this sucks. I really don't like when companies do this. But what'll happen is a lot of companies, when they have what am I trying to say, a HELOC, instead of calculating the monthly payment as an interest-only monthly payment, they'll calculate it based on 1.25% or even 1.5% of the balance. And so in their case, I'm going to do some math because I actually don't remember exactly what their payments were or what their balance was. So 1744 divided by 0.0125 is 140,000. So they owed about 140 on this HELOC. And like I said, at 7.49, yeah, their payment was 870 bucks a month. So it could have saved them, what is that, $900 a month? That's a huge savings for somebody that's desperate. So I went ahead and kind of went through that with them and sent them over to America First and said, go in and ask them that to show you how the payment breaks down at 1744, how much of that is principal, and ask them if they have an interest only option. Now, I think this is stupid. Honestly, this really frustrates me. They made her apply to go interest only. And I don't even know what's involved in that approval. This is an open line of credit, guys. Open line of credit. If she pays the interest, why do you care about the balance? This doesn't make sense. And don't tell me it's some law or rule because a lot of other banks and credit unions out there just go straight interest only. They don't even bother with this bigger payment. What is the matter with you? So if somebody at America First that has some kind of sway on this is listening, turn that stupid thing off. Stop putting this 1.25% on clients like that. It's so dumb. Or feel free to call me out for my folly as well. But this is what I told her. I said, so first off, recognize that even if they tell you no and they won't let you make monthly payments that are only interest only, recognize that you have the power to reimburse yourself. And so what you're going to do is of the 870, right? Or of the 1744, only 870 is the taxes or the interest. So that means that if you take immediately after you make a payment, you can even make it in person, which she typically made them in person. I make all mine automated, so it's hard for me to process why people would make all their payments in person. But I just too busy to do that, frankly. But anyway, I told her you can even set up an auto withdrawal to take 873 bucks and dump it right back into your checking account same day or next day. And that's going to be effectively the exact same thing as having an interest only payment. So yes, you'll have the 1744. Yes, you'll make it. And then the very next day, you'll have 870 dropped right back into your checking account. So you've effectively only paid the 870 towards the interest. And that brings me back to the beginning of, do you understand your loan terms? Have you taken the time to understand your loan terms? Why not if you're not, right? Like, yeah, just I don't know. Why some people it's like they feel like it's avoidable. Guys, there's a lot of details in life that you can kind of ignore, and analytical people like me, we like to dive into the depths of those, but there are certain details in your life that you really have to stay on top of. And I don't, when you were in school and you were studying a course, you had to take notes, you had to record the class, you had to do study groups, you had to get a tutor. There's all kinds of different things you have to do in order to understand and learn these topics. Well, this is one of those that's at least as important as every course you ever took. And this behavior you have to get on top of. You have to know the details of your mortgage, all of them. And if you don't, this is what's going to happen to you. This story I'm talking about. She tried to sell her house, guys. All she needed to do was go interest only. But she didn't understand her loan terms. She didn't read them, and that's kind of on her, right? That's her responsibility. But she got yoked up with a bank who made stupid policy decisions, and neither of them are thinking very clearly, in my opinion. So anyway, be responsible for yourself. Take the time to understand your loan terms. All of my clients always get their loan terms thoroughly explained. Any of you guys listening to this know that. If anyone has questions about their loan terms, I'm happy to help you figure things out. There's a 100 page packet that people sign at closings. There's only about 3 to 5 pages that really matter. All the rest of it's mostly fluff. Okay, let's go ahead and start to move on. This actually kind of brings me back to like 2008, as I mentioned when the housing market was crashing. I talked about how many people weren't reading their loan terms. Well, one of the things that was going on a lot in 2008, and I'm going to lead it this way. In finance, the things everyone knows are usually the things that cost you the most money. Arms are dangerous is a 2008 ghost story that keeps 2026 buyers from massive wealth. ARMs stand for adjustable rate mortgages. So let me rephrase that. Um, Adjustable rate mortgages are dangerous is a 2008 ghost story that's keeping 2026 people from massive wealth. So let me kind of elaborate now what I'm talking about. So in 2008, and not even '08, more like '07, '06, '05, '04, people were closing on mortgages. They weren't reading their loan terms. Their interest rate might have been like a 6% interest only, but it was an adjustable, a 2-year adjustable. So it was fixed for 2 years, and then it would become an adjustable every 6 months or a year. Most of them, the longest was 3 years. All those were the terms of almost every subprime loan that was done. And if it was a subprime loan, the reason that they would do these loans, I don't actually, never mind, I'm not going to frame it like that. Um, the reason I'm bringing this up is because it may be a 6% interest rate, but the margin of the adjustable rate was such that the day it started adjusting, that rate would go to 12%. I ain't joking, guys. I know so many clients whose adjustable rate, when it adjusted, went all the way up to 9%, 12%, and rates like that. And it's no wonder they couldn't afford their payments anymore. Their payments doubled. Granted, even then, they're still less than our $3,000 and $4,000 house payments today, a lot of times. But yeah, that was the dilemma with those days. And so, same story I told earlier, if you understood your loan terms, you would do something about them. But a lot of people were just happy to sign the bottom line. They get whatever. And then a big shocker, there's weeping, wailing, and gnashing of teeth later on. So, anyway, let's go ahead and continue on the arms. So, arms, that's where arms got their bad story is because of those subprime arms. Now, to be clear, I'm not talking about any subprime arms right now. I'm actually talking, so I don't know if there are subprime arms. There really isn't a market for subprime anymore, where you have a 500 credit score or bankruptcy yesterday and stuff like that. There's not really a market for that. So, the arms I'm talking about are the conforming and FHA and VA arms. Those are really the arms that I'm talking about. Adjustable rate mortgages are abbreviated as ARMs. And the most common type right now are hybrid arms. And what a hybrid is that means that it's a hybrid between a 30-year fixed and an ARM. So ARMs just mean that it adjusts, but you need to ask the question when and how frequently. We'll also talk about how much. But a 30-year fixed, as you know, the payment never changes, the interest rate never changes. So a hybrid would be something like that, where for a minute it's like a 30-year fixed, and then it shifts over to an arm. So the most common ones are a 3-1 arm, a 5-1 arm, and a 7-1 arm, maybe a 10-year arm. And I keep saying 1, 5-1, 7-1, but honestly, there's 5-6 and 7-6 and 10-6 arms as well. And that differentiation is actually important. So, whenever you're talking arms, it's important to understand that there's an index, there's a margin, and there's caps. And your margin and your caps are king. The margin back in the day, in 2008, those margins were often 6, 7, 8, 9, or even 10%. And that's why people had such big issues. And then the caps, it depends on what loan we're talking about, but the caps can also be really, really important. So on an FHA arm, that's the most favorable. An FHA arm, the index is going to be, well, the index, excuse me, this is the margin, right? So the index is going to be the 1-year CMT, the constant maturity treasury. That's a very stable index. It doesn't move around all that much. It moves with whatever the treasury interest rate moves to. But it's the constant maturity treasury. And so it's going to go up in good markets. It's going to go down in low in bad markets. And of course, that's when you want it to go down because, and I got to tell you my story too. Anyway, so it's going to go that's your index. And then you've got your margin. On an FHA, your typical margin is going to be 2.25%. And 2.25 plus, let's say your index is 2%, 2.25, that means your rate's only 4.25. Or if your margin or your index has gone up to 5%, 2.25, that means your interest rate is going to be 7.25. Okay. And then there's caps. And the caps are the maximum adjustments that it can make. Now, on an FHA loan, it's a 5-1 arm or a 3-1 arm. It means it's only going to adjust once a year after it's 5 years or after it's 3 years or whatever term you end up with. Okay. So if you do a 5-1 FHA arm, then for 5 years, it's exactly like a 30-year fixed. functions and feels exactly the same. And then on the sixth year, then it moves into the adjustable. It adjusts once a year. So it looks at what the index value is that year, at the beginning of that year, and then it adds that margin of 2.25%. And then it figures out what the caps are, and the caps are like governors. They can only move within whatever the cap says. So let's say your initial interest rate is five, yeah, we'll say 5% for the sake of easier math. And then let's say that 5 years from today, the economy is running fairly low, kind of meh, and you find out the index is 3%. Okay. And so 3% margin or index plus a 2.25% margin, that makes 5.25. Your interest rate's 5% before the adjustment. The cap is a 1% maximum adjustment. So it'll let the rate go up 1% or down 1%. In this case, it's going to go up 0.25% because that's what your margin and index equal, right? When you add them together. So then for year six, your rate's going to be 5.25. And then year seven, it's going to do the same thing. What's the margin? Let's say that the market's got pretty sour and the margin's all the way down at 2% now. So 2%, let's actually make it lower. So it goes down to 1.5%. And then your margin is still 2.25. So you're going to add 2.25 to 1.5. And that's going to be what? 1 point or 3.75. Is that fair? If I'm doing my math right? So if you're at 3.75, remember your rate's 5.25. The cap says it can only go up or down 1%. So your cap in this case is going to drop it to 4.25, and that'll be that. It won't let it go any lower, even though it should go to 3.75. It's not going to let it because the cap has a 1% up or down maximum adjustment. That make sense? That's how an adjustable works. Now, the FHA and VA arms follow that pattern. Conventional does not. Conventional has much more significant adjustments than are very important. So if you're taking a conventional arm, make sure that you're doing your homework. They follow the SOFR, the standard offered fixed crap, what does that stand for? Anyway, it's basically the prime rate. It's basically what the Fed funds rate is doing, which is a very volatile index. It can move up very fast or down very fast. And it has been not so much lately, but in 2021 and 2022, it started going up. It went up 5.25% in 18 months, or was it longer or shorter than that? So that's an index that I'm personally am not that comfortable with. And then the margins are still typically 2.25%. And then the caps, now this one has an initial first cap and then an annual cap after that. So typically, and it's usually a 5/6 arm or a 7/6 arm, which means it adjusts every 6 months, not once a year. And when it makes it its adjustment, its first adjustment, the cap is typically 5%. So that can be a big change for the very first adjustment. Second thing, the second adjustment on is typically a 2% cap. So these loans, the conventional Fannie Mae, Freddie Mac, I don't know why they chose the SOFR. I do not feel like that was a smart choice. They used to follow different indexes that were better. There used to be an index called the LIBOR that was more like the CMT, but they chose not to follow that index anymore. So I'm not as big of a fan as these. They're not near as stable. However, there are some pros. Why? So that's how they work. Let's talk about why would somebody even want an adjustable? Maybe I should have led with that. Number one, more buying power. The 5/1 arms, the 6/7/1 arms and stuff, we typically qualify somebody with that. And it may only be a 0.25% lower rate. It might be a 0.5% lower interest rate up front. But that enables you to have more buying power. With 0.25%, that's probably $20,000 in buying power, maybe 30, depending on the rates. So if you can get a 0.5% lower, we're talking about, $50,000 or more in additional buying power. So that's a big deal. More buying power. You're actually going to save more money on these. And this is a weird thing that whoever can explain how amortizations actually work and who came up with this stuff. Um, but an adjustable rate actually amortizes faster. Low interest rates in general tend to amortize faster. What I mean by that is they pay principal off earlier. I don't necessarily understand why. That's outside my experience, but so if you look at a 30-year fixed and you look at a 5-year arm, after 5 years, the 5-year arm will have a lower balance, even if they're at the same interest rate. It's weird. And when they do make that first adjustment, they have made that adjustment based on the existing principal. And since they've paid off more principal than a 30-year fixed, you're typically going to save more on a 5/1 ARM for the first 7 years, assuming the worst adjustments you can have. Your first 7 years is typically going to save more than what your 30-year fixed would have done. So hopefully that makes sense. I think that's about what I wanted to tell. Other than my own story, for anybody that doesn't know this, I bought my very first house. My wife and I got our first house, and I chose not only an adjustable rate, I chose a 5-year ARM, but I also chose a interest-only 5-year ARM. Those were prevalent back in 08, '04 when I bought my first house. And probably I wasn't financially disciplined enough or fiscally responsible enough to do it, but I was more interested in a small payment than I was, you know, paying my house off and stuff like that. There were moments where I regretted that choice, I will be honest, but in 2008 or 2009, I should say, was not that moment. Now, as you know, 2008, the housing crash had started and everybody was freaking out. Well, my mortgage went from, I think it started at 4.75 all the way back in '04. So that'll tell you a little bit about ARMs back then. The 30-year fixed rates were not that low, but my ARM rate was. And so I got a 4.75. Of course, I'm sure I gave myself an extra good deal. But then beside that, in 2009, my rate went down. And in fact, my rate started adjusting down because the markets were in the toilet, right? My rate started adjusting down so that in '09 and 10 and 11 and 12, my rates got all the way down into the twos. So you are looking at the first person to have a rate in the twos before the pandemic. Yeah, I was that cool. I'm sure I wasn't the only person in the planet to have a 2% rate, but I sure felt special and I sure loved that interest rate. And of course, in 2012, 2013, rates got down into the 3.25% range for a 30-year fixed. And so that's what we did at that point is we were able to refinance out and just lock something in permanent like that. So that was kind of how an arm worked for me. And I know everybody else's story is a little different, but wanted to share that. All right. I think I'm going to close with, yeah. So anybody that's followed my career at all, sometimes this comes up and people ask me a little bit about why are you a mortgage broker? Why are you here? And there's a little bit of a, so I want to tell you a little story of my career, if you will. Um, here's my hook for you, if you will. This is what I wanted to, how I want to frame it. I didn't leave the big banks to get a better office. I left because I wanted to be a rescuer, not an order taker. If you're an outlier, the big systems will fail you. I became a broker so I could handle messy underwriters and the tough appraisals that the big guys run away from. Um, when I was at Academy, which I was there for 8 years, great company, loved working there. But while I was doing that, the two strengths that they had is we had in-house underwriting and we had in-house appraising, and that gave me a lot of solutions to those problems, which I absolutely loved. The biggest drawback is that our margins were such our corporate costs were too high, and it made my interest rates too high, and I didn't want that for my family, my friends, my trusted or my clients that trusted me to give them good deals. So in 2018, I went back into the broker world for the second time. And my biggest concern was, could I still close a loan in 2 weeks? Could I still have enough control on the appraisals? So here's the secret to appraisal, not the secret. Here's one of the problems with an appraisal. Um, there's such terrible communication between the buying and owners of the properties that and the appraisers that there's a lot of errors that end up happening. A lot of low quality appraisals will be done and they'll have issues with their CU score, which is kind of a grading mechanism for appraisals. And it just creates drama in files. And we had that under wraps at Academy, and it was really great. In fact, we were able to rescue quite a few clients who had drama problems or appraisal drama. I didn't want to lose that, so I was really nervous about that when I went into the broker world. And then, like I said, in-house underwriting, we were able to close our loans in 2 weeks. And that's a huge value for many folks. If you're one of them, then you recognize that if you're listening to this. So when I went into the broker world, those were my two biggest concerns is can I handle that? Because I know I can offer better rates, but can I handle that also? And after kind of making that move and kind of experimenting for the first, 3, 4, 5, 6 months, I found that not only can I close in 2 weeks, I can close in 2 weeks every time. And not only that, but I also found I have even more flexibility. The appraisals was not easy. The appraisal took a lot of extra finesse. They've gotten a lot better over the last few years, but they took a lot of extra finesse those first few years. And then after being at that particular broker shop for a while, um, pricing never came up. Nobody was rate shopping. They'd ask me my rates and that was it. That was the end of the conversation. They'd be like, okay, when can we close? So I knew my rates were very competitive at that time, but around 2022, I think, that started to change and I started noticing more and more competitive offers out there. And so I talked to my company about making an adjustment to our rates and stuff, and they were not excited about it. And so I shopped around with some other companies, and I found another company, the one that I'm at now, First Class Home Mortgage. And Josh Thomas Mortgage is a DBA of First Class Home Mortgage. And they already had the margin that I was looking for. That ever since 2022, I've almost never been rate shopped by anybody with anything other than, hey, your rates are great. And they usually close with me. Every once in a while, I'll hear some stories, but there's specials all the time. But I made these changes because I wanted to be able to offer such a good deal to every one of my clients that I would be happy offering the same deal to my mom or my sister or anybody that wanted to get a loan through me that was close family. And as it turns out, it's not my mom, it's my kids. My kids are getting loans from me now, which that's kind of weird. Um, but yeah, I just wanted to make sure that whatever deal I was going to give them, I could offer everyone. And that's really what we've worked on doing over the last several years is trying to get to a point where we can continue to offer these crazy fast closings. We continue to offer the wisdom of the 20 years of doing this and the problem solving. But at the very same time, we can also offer screaming deals so that our clients don't even need to shop around. They know they're going to get a screaming deal every time. I don't just have to swing a deal for somebody because all of my clients are always getting screaming deals. Like they can go shop around and they'll find out that I'm $4,000 or $5,000 cheaper. I'm already giving them the deal. Um, and that's where we're at today. And I think I'll finish on that. So that is why I'm a broker here right now, where I'm at. That's how we structured our business. It's not that easy to carry the weight of the appraisal management. There's a lot of extra steps that we have to take in order to make sure that that's a thing. But same thing with the underwriting. Sometimes the underwriters they kind of rebel a little bit, and it makes my job quite a bit harder. But wanted to just kind of let you know that's kind of our background. And so, just as a quick recap, just kidding, it's a video. I'm not going to recap the video. You can just watch it again if you need to. Watch it faster. But anyway, thank you for joining us today. Thanks for taking your time to hang out with me. Hopefully, I kept you good company in the gym or on your ride home or something, wherever it is that you're traveling to or from. And but yeah, share this if you know of somebody who's been concerned about retirement. Somebody that needs a little kick in the pants to read their own paperwork or maybe needs some help reading it. Feel free to share this with them. That is part of why I talk about it. So, other than that, wish you a great evening for me, and maybe it's a morning for you, and we'll catch you later.